91 Global Environment invest in companies that have products and services that avoid carbon. Those companies are likely to see higher revenue growth, better performance as the world moves more quickly to decarbonize. They include companies in the renewable energy value chain. So to move to net zero, we need to move away from fossil fuels towards renewable energy. They include companies in the electrification value chain. Electricity across the world is taking enormous market share away from other forms of energy, and companies in the energy efficiency value chain, as well as companies that decarbonize agriculture and land use, that decarbonize waste, that decarbonize consumer products. So it's a very wide variety of different types of companies that sit across many different gig sectors and many different regions of the world. We start with a bespoke universe screen using revenues and carbon data that we get from the Carbon Disclosure Project in order to find those companies who have products and services that avoid carbon. We then look through that universe using a quantitative idea generation screen to find those companies that are more likely to have really high structural growth, more likely to have really strong competitive advantages, and therefore generate strong returns above their cost of capital over the cycle. We then do a really deep dive fundamental research process where we look at all of the drivers of the company's revenues and cash flows. We build proprietary valuation models, looking both at base bear cases and also upside net zero scenarios, and then allocate capital to companies that hit all three of our criteria: have structural growth from decarbonization, have strong competitive advantages, can generate sustainable returns above their cost of capital, sustainable in every sense of the word, and are attractively valued. We then size our positions based on contribution to portfolio risk so that we allocate more risk to those names where we have the highest conviction and we really expect those companies to outperform. So this fund tends to perform better when the world is more optimistic on the journey towards net zero, when expectations on the pace of investment in decarbonization are a little bit higher. Conversely, when expectations on the pace of investment in decarbonization are lower, when people are really pessimistic about whether or not we are going to make that transition to net zero, that tends to be a headwind for growth in the revenues and cash flows of the companies that we invest in. We try to protect against that by looking for companies with strong competitive advantages, companies that have regulatory tailwinds but are not regulatory dependent. But nonetheless, it's difficult for this strategy to outperform global equities when sentiment on decarbonization is weak. As a fund that invests in companies that have products and services that avoid carbon, ESG is absolutely integral to our investment process. Every single company in the strategy is avoiding carbon. We engage with every single company in the strategy to encourage them to allocate more capital, R&D resources, more people to the divisions that are really helping to contribute to decarbonization. And we also engage more broadly on ESG topics such as diversity and inclusion, supply chain risks, labor, treatment of labor, corporate culture, corporate governance, and a variety of other topics. All of those are disclosed in our annual impact report, which talks about every company we hold within the strategy and is available on our website. Most investors assign some probability to the world transitioning to net zero. The probability that you assign varies wildly across different types of investors. It also tends to vary significantly over time. When we have a lot of extreme weather events, when perhaps we have positive regulation on climate, people tend to ascribe a higher probability to the transition to net zero. At other times in the political or regulatory cycle, people ascribe a lower probability. But those companies that have products and services that avoid carbon tend to perform very differently to a typical global equity portfolio. Our strategy has very, very low overlap with typical global equity portfolios. So therefore, if you include an allocation to the strategy within a broader global equity allocation, it tends to often reduce risk and dampen volatility.